In today's episode, we revisit the topic of activism in the bank sector and the implications for M&A. We also revisit the behind-the-scenes liquidity dynamic that continues to influence sector stock performance. We take a look back at the year in review, and then we take a look ahead and talk about our expectations for 2026 and beyond.
Welcome, and thanks for tuning into the Talking Banks podcast. I'm Kevin Swanson, Senior Analyst with GenOpp Capital Management, and I'm with Joe Fenech, our Founder and Chief Investment Officer. Before we start, a quick disclosure. Joe Fenech, Kevin Swanson are employees of GenOpp Capital Management and an investment advisor that maintains exempt reporting status in the state of Indiana. This podcast represents the views, beliefs, and opinions of GenOpp members and does not assert to be complete. The information presented in this podcast is provided to you as of the dates indicated, and opinions presented may change. You should not rely on this podcast as a basis upon which to make an investment decision. This podcast is not intended to provide and should not be relied upon for tax, legal, accounting, or investment advice. GenOpp's clients or its members may hold or recommend to GenOpp's private fund clients the purchase or sale of securities of companies discussed in episodes of this podcast. So quite a bit to discuss today in the world of banks heading into the start of the new year. Last time, Joe, you talked about two topics that I wanted to revisit today. The first is bank activism and the obvious connection to the M&A activity that we're seeing. This has been an active year for M&A, more so than the past several years combined. And our expectation is that we'll see more activity in 26 and 27. Joe, there was a front page article in the Wall Street Journal last week on shareholder activism in banking, and then a month or so ago, a front page on CNBC as well. So this is getting a lot of attention. Any updated thoughts?
Thanks, Kevin. Quite a few thoughts on this. Enough, I think, to take up the whole podcast. But as I talked about last time, this topic is always going to get a lot of attention. It's a sexy topic, right? And I think the natural inclination for generalist investors that haven't been in the weeds of the bank sector for a while is that this is a reason to be interested in this space. And partly, I think, historically, that's been the right way to think about it. When we've seen spurts of activism in banking, the push has been for the underperforming target to consider a sale to a larger partner, a better performing partner. And the larger banks historically traded at a premium currency. The smaller banks traded at a discount. You didn't have quite the management succession issues you have today. So you had a balance of capable buyers and sellers. So pushing the underperforming bank to sell could wind up being a very lucrative proposition, even for subpar companies. Big premiums to market, 30, 40, 50% or more.
And the buyer's stock would sell off up to 5% at announcement, but by and large, it was manageable and the stocks would gradually recover. We've talked for a while now, even before this M&A wave kicked off, about how we thought this M&A cycle might play out differently than cycles in the past. Without getting too far into the weeds, there are different accounting rules than in the past. There's now a healthier level of skepticism about how to value a deal, especially around accretion income. You have interest rate marks in the held to maturity investment portfolio and in the loan portfolio that aren't reflected in tangible book value per share, but they have to be accounted for in a deal when the target's book is marked.
For sure. And I would add to that stock valuations are lower today in the past generally. There's also now, as we've talked about in the past, a general imbalance of buyers and sellers. There are not as many qualified, capable buyers, especially on the community bank side. You have management teams that are aging without succession behind them, which is one of the main drivers of that imbalance of buyers and sellers. And you also have a long-term body of evidence that strongly indicates that M&A is very difficult to execute well. So you put all of that together, and the capacity to pay on the part of the acquirers is not what it's been historically, at least not yet. So pushing an underperforming bank to just pursue a sale is not necessarily the lucrative payday on day one that it's tended to be in the past. So I think going all in on buying these underperforming banks and pushing them to sell, you're using an outdated playbook for circumstances today that are completely different than in the past. You could certainly make a lot of money still on this consolidation theme, but there's quite a bit more nuance, I think, involved today because of these changed dynamics. And look, the activist case is not really difficult to make against just about any bank, apart from, say, a JP Morgan and a handful of others. I mean, consider this. The regional bank index, the KRE, was 6450 in May 2018. It's 6490 as I'm speaking today, 7.5 years later. So if you go back further than that, you have the huge hiccup in '08. So with our background in writing research on banks, we could make an activist case if we wanted to on just about any bank because the stocks haven't gone anywhere, in some cases in decades. And in some cases, management teams and boards are very much at fault for decisions that have been made. There's certainly an entrenchment issue where this sector is protected by the regulations around shareholder ownership concentrations. That's insulated the companies, I think, in a way that sort of encourages an attitude of, I'm going to do whatever I want to do, and there's nothing really you as a shareholder can do about it. And except for a very brief period during the first Trump administration, and then starting again right around now, there's been a moratorium on regional bank M&A. So literally, even if your concerns were heard and were acted on, there wasn't even a viable mechanism for forcing a sale of a bank because it wasn't allowed. So this diatribe I'm on here, it's not meant to protect underperforming companies. The activists are correct in just about everything they're saying. But again, it's not a difficult case to make when along the way you've had 2008, 2020 with the pandemic, 2023 with the liquidity panic, which resulted from, I think, the massive stimulus, both fiscal and monetary, that we saw in response to COVID. It wasn't necessarily a failure of risk management on the part of the banks. Those valleys that I mentioned have made it almost impossible for any bank to show strong stock performance, which is then layered onto the board and management entrenchment issue that's very real.
So, if I'm hearing you right, there are legitimate issues and concerns driving the activism. The regulatory environment is such that there is a viable path to force a certain outcome. But that short term outcome might not necessarily be what we want to see as shareholders.
Yeah, I think that's a good summation of it. There shouldn't be a one size fits all outcome here. You have to know each situation, and I'll get into an example in a minute. But also, look, we're as bullish as we've been on the fundamentals of the sector in 20 years. I think the road ahead looks really good. But this sector has also had unexpected calamities I just talked about. So I think you also want to approach this NA and activist euphoria with a bit of a wary eye, given everything we've been through, right? Even if there were huge M&A premiums to be had, which, as we've talked about, it's more of a case by case situation at best, where you will see that. You have to ask yourself, what if we're wrong and M&A shuts down, or we get a sharp economic downturn and credit rears its head, or the political winds change? Now you're stuck concentrated in a bunch of subpar operators that, if history holds, will perform much worse than peers will in a downturn scenario. So I just don't think the risk reward dynamic of extreme concentration on that activist M&A theme works through the cycle. And it definitely, in my opinion, doesn't work if your macro assumptions obviously don't pan out like you think. So bottom line, I think there's definitely room for this to be a major theme in an overall investment thesis on the sector. We're certainly involved in it. We talked about the possibility of it long before it actually started happening. But I think you first have to understand how the playbook has changed. And second, the prudent approach is for this to be a component of a bullish thesis on the sector. It's not the be all and end all, because we're heading into what I think will be a really fruitful fundamental backdrop for these companies and these stocks over the next few years.
So, large bank M&A is heating up right now, not because an activist is pushing these companies to do something. It's heating up because the fundamentals are good. There's a regulatory window that's opened up to do these type of deals. And obviously, that window in sort of this volatile political environment might not remain open forever. Are activists and everybody else just sort of along for the ride here?
Yeah, I think the activist stuff is coincidental with respect to the timing. People forget, Comerica had an activist investor go after them in the past. I think the end result of that was that the company announced like an expense reduction plan or something and then continued to underperform. So they just, like I said earlier, there wasn't a mechanism to sort of force action there. But let's use that situation as sort of a case study to illustrate the point we're trying to make here. So in full disclosure, we owned Comerica long in our fund when the deal with Fifth Third was announced. We still own it today. We thought the M&A window for regional bank M&A would have opened up a little earlier this year than it did. That's what we thought heading into 25. But everything got sort of pushed back by the tariff situation, Liberation Day. The whole market sort of seized up till the second half of this year. This is one of the largest non-distressed bank deals of the last 2 decades. There's virtually no possibility, in my view, that an activist went public with its stance on this company in July, and then the company, Comerica, turned around, decided they needed to sell, and had this huge deal announced by early October. Our view that we've articulated now on numerous occasions is that virtually every large bank over 50 billion in assets, and likely even smaller than that, but let's stick with 50 billion for now. Just about every large bank we think is going to be involved in some sort of transformational M&A situation over the next few years. And we've grouped those banks into two categories that we call the hunters and the hunted. There's a race to add scale. Some of that's due to technology. Some of that's due to the events of 2023 with the liquidity crisis in Silicon Valley Bank, where the large regionals lost market share to the banks that were deemed too big to fail, like JP Morgan, when there were fears of a deposit run on some of these banks. And some of that consolidation that's going to happen is just due to the natural course of things, meaning this is consolidation that otherwise would have occurred naturally already if not for the regulator-imposed moratorium on large bank M&A and the volatility that made deals very tough to do over the last several years. And also, there's only so many of these properties available, right? So there's a mad dash to get things done. There's only about 25 banks left over 50 billion in assets, and there's only 6 or so in the markets deemed to be most desirable, that being the Southeast and Texas. And again, the window to do something, as you mentioned earlier, might be very narrow if we get a pendulum swing in the other direction politically in 2028. So all of these factors are converging at the same time, and that's why you're seeing regional bank M&A, and that's why we're going to see more of it.
And within those groupings, you have franchises that are worth a decent premium. There's scarcity value to those companies. There are responsible acquirers, and you have obviously some that aren't as disciplined. A lot of investment themes to play there just within that large regional bank space.
Yeah, I think that's exactly right. And if you take into account all of the considerations I laid out earlier, interest rate marks, valuation, capable acquirers, et cetera, I think Fifth Third paid a reasonable and fair price for Comerica. And that's talking against ourselves here there a bit because we own Comerica and we still do. So Fifth Third traded at just about the most attractive valuation of all the potential acquirers of Comerica. In our view. The way this deal was priced, there is no expected tangible book value dilution, which is what leads people to take a dim view of M&A in the first place. You don't have that here. The deal is nicely earnings accretive. You get a much stronger management team at the combined company, and you get improved franchise value at Fifth Third with the move into Texas with Comerica. Since the deal, Fifth Third stock is up about 10%, and the KRE, the Regional Bank Stock Index, is up 2%. There was another very significantly sized deal earlier this year with Pinnacle and Synovus. I think that was announced in late July, around that time frame. Since that deal was announced, Pinnacle stock is down 8% and the KRE is up 3%. I would say that most of the deals we've seen so far this year more closely resemble Pinnacle stock performance than they do Fifth Third's performance post-announcement. I think the takeaway there is if you push Fifth Third or someone else to pay a higher price, now you're talking about tangible book value dilution and other risks that are part of the reason why M&A hasn't worked in this space more often than not over the past 20 years. And you're going to give away the upside anyway, in our view, because Fifth Third stock or some other acquirer's stock likely wouldn't perform as well if the deal was done at a higher price.
And shifting a bit to the community bank side, dynamics obviously are much, much different than for the regionals. The community banks are more saddled with the interest rate marks compared to the regionals. There aren't as many capable buyers. The valuations are generally lower for the acquirers. And generally speaking, there isn't quite the scarcity value on the community bank side as there is for the regional banks.
Right. So pushing an underperforming community bank to just sell itself, I don't think is the cure-all, and it might not even be that lucrative an announcement as people might think. We're seeing a lot of deals so far this year where really attractive franchises are basically selling at current market prices for no premium. And people are sort of scratching their heads as to why. And I think the reason is because there's a lack of appreciation for how difficult some of these balance sheet dynamics are with the interest rate marks in these deals, and that's impacting the prices. So again, there's a place for all of this stuff. It's an important investment theme, and we're certainly playing it. But at the same time, I think we finally got the fundamental backdrop in this sector that we've been waiting for the better part of 15 years, right? Rates are higher, which is a good thing. Margins are up. The yield curve is steepening, regulations loosening, the economy's in good shape, credit's good, the Fed's lowering rates, and valuations are really reasonable. Regional banks, in our view, are going to push ROEs into the mid to high teens range here over the next 12 to 24 months, which means valuations on average should trend over 2 times tangible book value. Community banks, we don't think on average will get to quite those levels, but community bank profitability is generally going to improve as well. and it has been improving, and valuations are going to get better along the way. That to me is the real story here. M&A and activism is a component of this overall story, but I think it's important to understand the nuances there. It's not going to look like it has in the past. And also, I think it's important not to miss the bigger picture, which is a much more significant opportunity, and that's these fundamental trends we're talking about. There's definitely room for M&A. There's definitely room for some to leave the scene here and move into stronger hands, but we need to be very strategic, I think, as investors in how we approach this. Here we are at the front end of this new cycle, trying to force banks in some cases to sell for less than the valuation level that I think a lot of them are going to achieve on their own in the next few years without the M&A execution risk. The M&A is going to happen in natural course along the way for the reasons we mentioned. I think the Fifth Third Comerica deal is one of the rare cases of 2 plus 2 equaling 5, but in more instances than not, bank M&A historically results in a 2 plus 2 equaling 3.5. And that's been okay in the past because, the investors in the target banks can reap, like I said earlier, 30, 40, 50% premiums at announcement, and then they're gone and out of the stock. So, who cares how the acquirer's stock performs? But if you're not going to get that day one premium this time around in this cycle, to the extent you have in prior cycles, then what happens on day two matters. And that's why these deals have to be structured the right way. So I applaud activists for speaking up. I think they're correct in a lot of the assessments they've made. I think it definitely, the involvement of an activist affords some downside protection to some of these stocks, and maybe makes some banks think twice before they engage in behavior that's not quite shareholder friendly. But I also think we've seen in some recent deal announcements, I'm not going to name names because I can't prove it, some companies are starting to enter into M&A deals, yeah, and with the end goal of making them less palatable to a potential activist investor in order to sort of, muddy the waters and shield their jobs for the next several years. And we definitely don't want to see that either. So bottom line, one size does not fit all as it relates to this topic. I think people need to understand there isn't some unicorn universe of banks all trading at 3 times book that are just waiting in the wings to take up all these underperforming banks and buy them at big premiums.
That's great. So moving on, we wanted to provide an update on a topic we discussed last episode, which is behind the scenes liquidity dynamics that we would argue were more impactful to the sector's stock performance in recent months than commonly thought. So just a quick recap, we saw a spike in SOFR beginning in the early September timeframe. That peaked in mid-October, right around the time the bank stock index fell roughly 6% in a single day. That was also right around the time that a few significant credit issues were surfaced among the banks. Also, the recent data released by the Fed shows that the bank reserves held at the Fed dipped considerably. That started over the summer, and that decline accelerated through this November. So system liquidity has been an issue. We think it's been a significant issue for the stocks, and we think it forced the Fed into some of the more recent pronouncements, which are just as impactful, if not more impactful, than the decisions on short-term interest rates. Joe, any updated thoughts on that front?
Yeah, so I think the Fed's announcement on basically restarting QE light, I'll call it, with the December meeting, was an acknowledgement of some of the things we were talking about in our last podcast, that system liquidity issues were more serious than people had appreciated. Part of that was the government shutdown, which was obviously a temporary phenomenon, but the big part of it was QT. Quantitative tightening, and the effects that that has been having as the Fed has continued to shrink its balance sheet over the past few years. So the Fed first announced the end of QT in late October, but they said it would end on December 1st. And then in December, they took it further and said it would be doing what we interpret to be a form of QE, the opposite of QT. So now going from several years of shrinking the balance sheet to now slightly expanding the balance sheet. Bank stocks had already started to recover from the swoon in September, October, but ratcheted higher on this news, which was, of course, attributed to the rate cut. But we think the tell was what happened to SOFR, which we think, we've said we sort of think of SOFR as a sort of proxy for the efficacy of the plumbing of the financial system behind the scenes. SOFR went from 4.3% on October 28th to around 4% on December 8th. And then almost within a day after the Fed announcement on QT to QE went to 366 on December 11th. So it declined by 65 basis points in basically 6 weeks, which is huge. The bank stock index through this process went up about 13% from the Fed meeting in late October to the Fed meeting in early December. And then interestingly has been pretty weak into year end since around December 10th. So SOFR in relation to that, after bottoming out right after the Fed meeting at that 366 I said earlier, has started to tick up higher again after that. And now it's settled into the low to mid 370s after almost touching 380 last week. So still some volatility there, evidencing to us that maybe some of those back end plumbing issues, while improved, are not quite completely resolved. But we can't emphasize enough that the flip of the switch from several years now of QT to now QE light is really a paradigm shift. It's big news for the sector, far more impactful than 25 basis points of short-term, the market seems to get fixated on with the Fed at each of these meetings. And it came about, this switch from QT to QE light, because there were some troubling issues behind the scenes. And that has had more of an effect on sector stock performance, we think, these last few months than is commonly appreciated.
Okay, so these are complex topics, and we probably underestimated how much time it would take to really walk through them in detail, but let's move on. The year in review for banks. Let's talk about things that were aligned with our expectations and then things that ran counter to our expectations for the year. And then we can talk about the implications of that for the year ahead.
I'd say, broadly speaking, that fundamentals inflected positively the way that we had hoped they would, but that fundamental performance has not yet been fully reflected in most bank stocks as of yet, to the extent that we maybe would have thought heading into 25. So essentially, it's a timing mismatch, which I'll take all day long over the inverse of that, which is that we were expecting the fundamentals to improve, and that turned out to be either wrong or something happened to derail the thesis.
When you say most bank stocks, that doesn't include obviously the very largest banks, which had performed extremely well.
Yeah, that's a good point. So Citigroup was up over 65% in 2025. AP Morgan about 35%. Wells Fargo about the same. Bank of America was up in the mid 20s. So, a lot of talk and press about Mag 7 and AI, but as a group, you would have been better off in the big banks. Just terrific performance by the big banks in 25, both fundamentally and stock performance. And then you look at other headline large financial stocks like Goldman Sachs, Morgan Stanley, Bank of New York, each up between 40 and 50% on the year. But I think a common misperception by casual observers of the sector is that everyone must have looked as good as the headliners. But when you dig deeper, the regional bank index, the KRE, was only up about 8%. The NASDAQ Bank Index, which is more community bank oriented, was up about 6%. So the big banks crushed the overall market, and the little banks significantly underperformed the overall market, which is an interesting dichotomy within the same sector.
When we talk about the biggest banks, though, isn't it fair to say that the fundamental turn came much earlier for the big banks? They've been performing well for a few years now, even going back to the liquidity panic in 23. The largest banks were beneficiaries of the deposit flight out of the smaller banks. JP Morgan outperformed the S&P that year in the midst of a banking crisis, and these bigger banks were just naturally more liquid in terms of their balance sheets. They were more asset sensitive. So they actually benefited as rates moved higher, which was not the case for most smaller banks. And they had capital markets and trading businesses that did well. So they weren't as tied to the yield curve, which was as deeply inverted and for a longer period of time than any time in the last 40 years. And the yield curve only disinverted fairly recently.
Yeah, I think, and layered onto that, the biggest banks were also the most direct early beneficiaries of the deregulation of the sector. So remember, the biggest banks were required to hold much more capital after Dodd-Frank, so they had a significant amount of excess capital, more so than the smaller banks, which were not as capital restricted in terms of what they could do. Kevin, you found that great statistic that you calculated, which shows that JP Morgan had excess capital, or has excess capital, that's equivalent to the size basically of PNC Bank, which is the sixth largest bank in the country, which is pretty mind-boggling. I mean, excess capital on JP Morgan's balance sheet alone equaled the size of one of the largest regional banks. So as those capital rules were relaxed, even if nothing gets better for the big banks fundamentally, their return on capital goes up over time because the denominator of the equation decreases. And some of them were already doing mid to upper teens ROEs, even with all the excess capital that they had. So even though the last few years have been characterized by a lot of headlines around problems at banks, we'd argue that things have never been better for the biggest banks in the country. They've never been stronger. They thrive through the inverted yield curve because of how their balance sheets were structured and because they had offsets to traditional spread-based banking income. And so the macro backdrop has actually really provided a tailwind for those banks, where it's been a huge headwind for just about all other banks.
And I think what's interesting to note there is that even though the fundamentals have been great for these banks for a while, as recently as 2024, so exactly 2 years ago, you could have bought JP Morgan for 11 times forward earnings, Wells Fargo and Bank of America for about 10 times earnings. Today, JP Morgan sells for almost 15 times forward earnings, Wells is almost 14 times, and Bank of America almost 13 times. So that's a pretty astounding multiple expansion in just 2 years.
Yeah, and so I think that's how the experience of the last few years ties in with what we see ahead. So regional banks' fundamental performance really only inflected this year, meaning 25. Remember, as recently as March 24, Flagstar, formerly New York Community, was rescued and recapped by Steve Mnuchin, and that whole first half of the year was dominated by fears of commercial real estate Armageddon. That was less than 2 years ago. And then the yield curve finally disinverted in September 2024 and then steepened in 2025. Those regional banks, as we said earlier, have less capital markets offsets, less trading. So they were much more tied to what was going on with the yield curve and traditional spread income. Also, deregulation also benefits for sure this next tier lower of banks in the large regional category, and that's only just starting to play out for them. So what we see happening is all of these regionals are providing medium-term ROTCE targets in the mid to high teens. So the tailwind of improving fundamentals is happening for these banks as well. It's just happening on a bit of a lag to what we saw with the largest banks. And it just takes time for that improved fundamental performance to be recognized in the market, just like it was for the biggest banks. So if you look out to 2027, these large regionals on average are trading just under 10 times 2027 earnings. And these are the regionals over 50 billion or so of assets. The smaller regionals, in the 25 billion or so range, trade at 9.5 times 2027. So what we think you're going to see this year is a broadening out of that tailwind. You're going to see a re-rating of these banks back closer to historical norms, just like what we saw with the largest banks over the past year or two. And a year from now, let's assume the regionals trade at 12 times 27 earnings, which is not a heroic assumption by any means. You're looking at over 20% price appreciation for the large regionals and about 25% for that next layer down, the smaller regionals. And that's without any increases to estimates for this year and next, which is definitely possible in our view, if not likely.
And for community banks, I think it's fair to say for now, we're being a little more selective. Fundamentals are improving for sure, and these stocks are extremely cheap. Most are trading between 8.5 to 9.5 times 2027 earnings. But it's going to take a little more time for investor sentiment to warm to these stocks, just like it's taken more time for investors to warm to the regionals compared to the largest banks.
Yeah, I do think a rising tide is going to generally lift all boats, more so than what we saw in 25. So the community banks should do just fine, but I think you're right. The real opportunity there is when the regional bank index, which is dominated by some of the larger companies, once that settles in, the index settles in, there's going to be a tremendous opportunity to sift through the smallest names that may have been left behind. And that's where you start generating very significant alpha, right? Because you're getting pops in these smaller off-the-run names, whether it be through just fundamental improvement, investor sentiment improving towards those names, or M&A, and those names aren't in the index, and then the index is sitting there basically flattened out. So that's similar to what we saw in the mid to late 2010s in banking. There was a recovery period after the Great Recession in 2008 that was led by the largest banks in 2009 as they were recapitalized. And then things settled in, but there was a long period there of opportunity sifting through smaller under the radar type names. And that's what we think is ahead for the community banks, just not quite yet.
On that note, we're going to wrap up. Thanks to everyone for listening, and have a happy new year.